an AI system can write a flawless investment memo, flag a suspicious trade, and recommend a portfolio change, and still be dangerously wrong. The most convincing output may be the one that deserves the most scrutiny. When AI influences real money, real clients, and real risk, who verifies it, who controls it, and who is accountable when it fails? This lecture reveals the ethics, controls, and governance that responsible AI demands. We will discuss AI risks, ethics, governance, and the future of investment management. Artificial intelligence is changing the way investment firms work. It can help analysts summarize filings, screen securities, monitor risk, detect unusual activity, draft client communication, and support portfolio research. That sounds powerful, and it is powerful. But in finance, power always comes with responsibility. The key question isn't simply, can AI help us? The better question is, under what conditions should we trust, verify, modify, or reject what AI produces? That question is central because investment decisions affect real portfolios, real clients, real trades, and real risks. A model may write a convincing investment thesis. It may rank securities. It may flag a compliance concern. It may recommend a portfolio adjustment. But the responsibility doesn't belong to the model. The responsibility remains with the investment professional and the firm. So throughout this lecture, I want you to think about AI as a tool inside an investment process, not as a replacement for judgment. Responsible AI use combines useful automation, verified evidence, human accountability, and strong risk controls. By the end of this lecture, you should understand not only what AI can do in investment management, but also where it can fail, how professionals should govern it, and why ethical judgment remains essential. AI tools can appear in many parts of an investment organization. Some are easy to notice. For example, a research assistant that summarizes earnings calls, a chatbot that helps clients understand portfolio changes, or a platform that screens securities based on selected characteristics. Other tools are less visible. They may be embedded inside order routing systems, trade surveillance systems, compliance monitoring engines, risk dashboards, vendor analytics, or client segmentation tools. This matters because the same technology can have very different risk levels depending on how it is used. An AI tool that summarizes public information for an analyst is very different from an AI tool that automatically changes a portfolio, sends an order to the market, or helps approve a client-facing recommendation. In research, the governance question is whether the analyst has checked the sources, the assumptions, and the interpretation. In portfolio management, the question is whether the recommendation fits the mandate, the risk budget, the liquidity needs, and the constraints. In trading, the question is whether limits, controls, and emergency stop procedures are in place. In compliance, the question is whether alerts are reviewed properly and whether false alarms or missed warnings are monitored. A useful principle is this: the closer an AI tool is to client outcomes, capital allocation, trading, or regulatory obligations, the stronger the oversight should be. So we shouldn't ask only, is this AI tool impressive? We should ask, what decision does it influence? Who relies on it? What could go wrong? And who is responsible if it does? Risk management and compliance are natural areas for AI because they involve large amounts of information, repeated monitoring, and pattern recognition. AI can help monitor portfolios for guideline breaches, concentration risk, liquidity concerns, restricted list issues, or mandate-specific constraints. It can flag unusual trading activity, suspicious communication patterns, or account behavior that deserves review. It can support client onboarding, fraud detection, sanction screening, and summaries of regulatory changes. But here is the important lesson: an AI signal isn't the same thing as a conclusion. If a surveillance system flags activity as unusual, that doesn't automatically mean misconduct occurred. It means someone should review the evidence. If a risk model suggests that a portfolio appears stable, that doesn't automatically mean the portfolio is safe. It means the model produced an estimate based on its data, assumptions, and design. In finance, this distinction is critical. An alert isn't a violation. A prediction isn't evidence. A model output isn't a final decision. Good compliance work requires review, documentation, and escalation when necessary. Good risk management requires asking whether the model's assumptions still make sense, whether the data are current, and whether the market environment has changed. AI can help professionals search for warning signs that might be difficult to detect manually. That is valuable. But the danger comes when a firm confuses speed with certainty. The professional mindset should be AI can help us see more, but we must still understand what we are seeing. AI generated investment analysis should be treated as a draft until the underlying facts are verified. This is one of the most important habits for students and professionals to develop. AI can sound fluent, confident, and polished while still making mistakes. It may misread a table, confuse two companies, use outdated information, misunderstand an accounting definition, or cite a source that doesn't actually support the claim. Verification isn't a clerical task. In investment management, verification is part of risk control. When you review AI-generated analysis, begin by separating the type of statement being made. Is it a fact? Is it an estimate? Is it an interpretation? Is it a recommendation? Each type requires a different level of support. Then ask what source supports the claim. Whenever possible, investment professionals should rely on primary sources, such as regulatory filings, audited statements, issuer reports, official data, and direct market data. Next, ask whether the source is current. A statement that was correct before may become wrong after new earnings, revised guidance, new debt issuance, litigation, or restated financials. Also ask whether the source actually says what the AI output says. A citation isn't useful unless it supports the specific claim. Finally, connect numbers and concepts to definitions. Financial terms can be defined differently across companies, databases, and reports. A strong analyst doesn't just repeat a figure. A strong analyst knows what the figure means. The rule is simple. No material claim should move from AI output to investment action unless a human can identify the source, understand the assumption, and explain why the claim matters. AI output can be fast, detailed, and persuasive, but investment decisions require more than speed. Human judgment is necessary because investment decisions involve objectives, context, trade-offs, ethics, and accountability. A model can process information and produce an output, but it cannot decide what level of uncertainty is acceptable for a specific client, mandate, or market environment. Human review is especially important when the decision is material, when data are incomplete, when market conditions have changed, when the model's conclusion conflicts with economic intuition, or when the output affects different clients or groups differently. But human review shouldn't mean simply clicking approve. Meaningful review asks whether the output is logical, evidence-based, complete, and fit for the intended use. This leads us to model risk. Model risk is the risk that decisions based on model outputs become harmful because the model is wrong, misunderstood, misused, or applied outside its proper context. In investment management, model risk can enter through many channels. The input data may be wrong or stale. The model may omit important variables. The estimated relationships may be unstable. The implementation may contain coding or pipeline errors. Users may apply the model to a decision it was never designed to support. Or decision makers may misunderstand what the output actually means. The key point is that model risk isn't only a technical issue, it is a governance issue. A sophisticated model can still be dangerous if it is poorly documented, poorly validated, used by untrained people, or allowed to influence decisions without effective challenge. AI systems depend on data, and in finance, data are often messy. Prices may be adjusted, companies merge, securities delist, index membership changes, accounting definitions evolve. Alternative data may be incomplete, noisy, or difficult to interpret. A model trained on flawed data can produce output that looks precise, but isn't reliable. Data quality risk becomes especially important when the live market environment differs from the environment used to build or train the model. If the old relationships no longer hold, the model may continue producing confident answers while its usefulness is weakening. Common data risks include using information that wouldn't have been available at the decision date, excluding failed or discontinued securities from the historical analysis, mishandling corporate actions, relying on stale information, combining variables that are defined differently, or using alternative data without checking permission and representativeness. Good data governance documents the source, ownership, permission, refresh frequency, transformations, limitations, quality tests, and access rights. Without that lineage, it becomes difficult to know whether an AI output is reliable or reproducible. Bias and fairness are also essential. In finance, bias can mean statistical error, but in responsible AI, it can also mean patterns that create unfair or harmful outcomes. Client segmentation tools, recommendation engines, risk tolerance models, and research systems can all affect people or securities differently. Bias can appear even when sensitive variables are removed, because other variables may act as proxies. A fairness review should ask what outcome the model influences, who may be affected, whether differences are justified by legitimate investment or risk considerations, and whether less harmful alternatives are available. Explainability and interpretability help users understand why a model produced an output and what that output means in context. This matters because investment decisions aren't judged only by whether they happen to work once. They are judged by whether the process is disciplined, repeatable, consistent with the mandate, and supported by reasonable analysis. If a model ranks securities, the portfolio manager should ask what features drove the ranking, whether those drivers make economic sense, whether the result is stable, and whether the model depends on unreliable or inappropriate information. There is always a trade-off between complexity and transparency. A complex model may detect patterns that simpler tools miss, but it may also be harder to test, explain, and challenge. A simpler model may be less powerful in some settings, but easier to validate and govern. The practical test is this: the explanation should be good enough for the risk of the decision. Now let's connect this to overfitting and false discovery. Overfitting occurs when a model learns noise rather than a durable relationship. This is a serious issue in investment management because markets are noisy, relationships change, and many strategies look attractive before costs, constraints, and live trading frictions are considered. False discovery arises when many signals, strategies, prompts, or hypotheses are tested. Some may appear promising by chance. This doesn't mean quantitative research is invalid. It means discovery must be disciplined. A signal should survive statistical testing, economic interpretation, realistic costs, capacity analysis, stress testing, robustness checks, and careful monitoring. A useful standard is this: a signal should survive not only the model, but also the market. AI washing occurs when a firm exaggerates, misstates, or vaguely markets its use of artificial intelligence. This isn't only a marketing problem. In investment management, claims about AI can influence clients, investors, counterparties, and regulators. If a firm says AI drives its investment process, it should be able to explain what the tool actually does, where it is used, how it was tested, what evidence supports the claim, and what limitations are disclosed. Risky claims include suggesting that AI predicts markets without proper support, implying that a process is autonomous when it is not, or using technical language to create the impression of rigor when the process isn't documented or validated. A good control question is: could the firm show a client, auditor, or regulator exactly what the AI tool does, and what evidence supports the statement being made? AI tools may collect, process, store, or transmit sensitive information. In investment settings, sensitive information may include client identity, holdings, transactions, financial goals, risk tolerance, tax information, communications, trading intentions, portfolio holdings, and proprietary research. A firm should practice data minimization, meaning it should use only the data needed for the approved purpose. It should confirm permission and consent. It should restrict access. It should avoid putting confidential information into public or unapproved AI tools. It should define retention rules for inputs, outputs, prompts, logs, and generated analysis. The practical rule is clear. Data shouldn't enter an AI system unless the firm can explain why it's needed, who can access it, how it's protected, how long it's retained, and whether the intended use is authorized. Responsible AI governance is the set of roles, policies, controls, and review processes that help a firm use AI in a way that is accurate, accountable, secure, fair, explainable, and consistent with its obligations. A good governance process follows the AI lifecycle. It begins with use case intake. What decision will the tool support? What harm could result from error? Who owns the tool? Who is allowed to use it? Then comes data approval. Are the data authorized, accurate, current, and fit for purpose? Next comes development and documentation. Is the model, prompt, or workflow designed for the stated use? Are the assumptions, limitations, and version history clear? Before deployment, the tool should be validated. Does it perform adequately on relevant data and realistic scenarios? Are limitations understood? Has someone challenged the result independently? After deployment, the firm must monitor performance. Is the tool still working as expected? Are there exceptions, overrides, drift, false positives, false negatives, or incidents? And eventually, every tool needs change control or retirement criteria. Models age. Data environments change. Business needs change. Governance should recognize that. Ethically, AI doesn't remove existing responsibilities. Investment professionals must still consider client interest, competence, candor, confidentiality, fairness, and accountability. A weak governance culture asks, can AI make this faster? A strong governance culture asks, can AI make this faster without weakening evidence, accountability, fairness, security, or client trust? That is the standard we should aim for. One of the biggest risks of AI is overreliance. AI output can create a false sense of objectivity. Because the answer appears confident and polished, users may give it more weight than it deserves. This is automation bias. Overreliance can create false confidence, weaken independent analysis, encourage herding, produce feedback loops, hide rare but severe risks, create accountability gaps, and allow performance drift to go unnoticed. The solution isn't to reject automation. The solution is to design oversight processes that allow AI to expand human capacity while preserving independent thinking, documentation, escalation, and final accountability. An investment firm can design oversight using a risk-based approach. Low-risk tools may need basic approval, user guidance, and confidentiality controls. High-risk tools may need independent validation, committee approval, ongoing monitoring, and periodic audit. For tools that can influence trades, client recommendations, or high-impact compliance actions, safeguards should be stronger. The firm should consider limits, independent review, anomaly alerts, escalation procedures, and a clear stop mechanism. At any time, a firm should be able to answer 4 questions. What AI tools do we use? What decisions do they affect? Who owns them? How do we know they are still working as intended? Looking ahead, AI will change the work of investment professionals. Analysts will focus more on source verification and interpretation. Portfolio managers will focus more on risk budgeting and accountability. Advisors will focus more on client goals and disciplined communication. Compliance and risk professionals will focus more on monitoring, validation, and escalation. The future isn't human versus machine. The future is human judgment supported by machine capability. Thank you for joining me today. I hope this lecture helps you understand AI risks, ethics, and governance in investment management.